Boosting your credit score can unlock a future of financial benefits such as easier loan approvals, lower interest rates, and access to elite credit cards that bring exceptional benefits. In fact, when borrowing $200,000 for a 30-year fixed-rate mortgage, having a credit score between 620 to 639 could cost you approximately $66,000 more in interest than if your score were 760 or higher, which, depending on how low your score is, you may not even get approved for a loan. Or when it comes to credit cards, gaining access to one like the Sapphire Reserve can give you tremendous travel benefits, which, by the way, the benefits are essentially free because you're already going to be spending money that you would have done otherwise, except now purchased through a credit card that offers significant rewards. So whether you're brand new to credit scores or you just want to learn all the tricks to building your own score, I have no doubts that if you pay attention to this video, it can definitely make a difference of thousands to even tens of thousands of dollars. And because this is all free content, all I ask from you is that you kindly hit the like button on this video. With that said, let's get straight to it by first going over what is a credit score and the factors that impact it. Now, a credit score is like a grade that shows you how well you manage your money, especially when it comes to borrowing and paying off your debt. Because of that, banks and other types of lenders look at your score to determine how risky it would be for them to lend you money or not. So the scores can range from 300 up to a perfect 850, which, fun fact, about 70% of people with a perfect credit score of 850 are baby boomers. But on the other side of things, 49% of US adults carry over credit card debt from month to month, which is obviously not a good thing to do. And that relates to having a total 40% of consumers having a score under 700. Now, in regards to actual scores, a famous software company called FICO is the most popular for its credit score data analytics, where they state that a score from 800 to 850 is viewed as excellent, 740 to 799 is very good, 670 to 739 is good, but then 580 to 669 is fair, and a poor score would be anything below 579. But these scores aren't just made up because they're computed by an algorithm, which the biggest factor that they state is your payment history that has the largest weight toward your score at 35%. A big factor here is to just never miss a payment that's due. Then there's the amounts owed, which is also known as the utilization rate, which is at 30%. This is determined by the percentage of credit you're using compared to the total amount you have available to use. After that is the length of credit history at 15%. This primarily considers the age of all your credit accounts, such as credit cards and loans, to show your experience with handling debt, which the longer you've had them, the better. Topping that off, another factor to your score is new credit that has a 10% weight. This basically means that when you apply for a new loan or credit card, your score is going to take a small drop temporarily, but in the long term, this is actually better, and it's only going to show on your credit report for 2 years. And then the last one is credit mix at 10%. This refers to the variety of credit accounts that you have, such as credit cards, mortgages, auto loans, or any others to show lenders that you can manage all kinds of debt. So overall, with credit scores, the higher the score you have, the lower the risk you are to lenders, which could save you money over time. Where a low score shows more risk, making it harder to borrow money and would lead to higher interest rates, which can cost you much more over time. So now that you understand the main components of credit scores, let's now go over the best ways to build your credit score, starting with the first, to become an authorized user. Being an authorized user means that you have been added as an additional card holder to someone else's card. This strategy is also known as credit piggybacking, which is going to allow you to benefit from the primary cardholder's credit history, which will appear directly on your account, where it can instantly boost your score. Oftentimes, this strategy is used by parents for their children or anyone in a credit hole that has deep trust in someone else with a good standing. According to the Federal Reserve on credit piggybacking, from those with only a few accounts reporting, the average increase in credit score gained 45 to 64 points. Just understand who you do this with, because any missed payments or high utilization rate or potential closing of the account, any other credit card activity, it will be directly reflected to your score. But of course, that is if the credit card company reports the authorized user to the credit bureaus, which right here's a list of some of the most popular ones and the minimum age that the authorized users must be. Just be aware that although many of these issuers, such as Capital One, Discover, and Bank of America, provide the full credit history for authorized users, American Express is a known one that does not. Besides all that, if you want to take this piggyback approach, you don't need to get or even use the actual card. Just make sure whoever you do this with has a strong credit history and understands the impact on their decision also reflects onto your score as well. So that is probably the quickest thing you can do to build your credit score fast. The next one is going to be to pay off balances early. As I mentioned, the amounts owed has a 30% weight towards your credit score. This is also known as the utilization rate, which is basically how much credit you are using compared to the total amount available for you. For example, let's say you have 2 credit cards that each have a credit limit of $1,000. Let's say you spend $500 on each card. That means you are using $1,000 of credit out of your total available amount that is $2,000. If you divide the 1,000 by 2,000, that is 50%, and that is your utilization rate, which is really high, and FICO recommends to at least stay below 30. But a good target to aim for is under 10%, which the lower the percentage, the better. Now, one thing you can do to improve this is to go and get more credit cards, but I'm not saying to go and get 5 of them all at once. If you just had 5 credit cards instead of 2, let's say your total credit limits were $20,000 instead of $2,000, and spending $1,000 on your credit cards would only be 5% of a utilization rate, which is really good. Another approach you could take to lower the utilization rate would be to call into the credit card company and ask if they can raise your credit limit on a specific card, which, depending on the issuer, just be aware that that could result in a hard pull, but the impact is small, only affects your credit score for up to 1 year, and will stay on your report for only 2 years. I highly recommend searching the credit card company before you do this, but to show you an example, Capital One states on their page, if you have a Capital One credit card, requesting a credit limit increase won't result in a hard inquiry. And by the way, if you hear anything about a soft pull, that means that it is not going to affect your credit score in any way. But another strategy that I highly recommend you get into a really good habit of is paying off your balances early, specifically the statement's closing date. The statement closing date is the day when your credit card issuer finalizes your account activity for that current billing cycle. Whatever the balance on your card is on the statement closing date, that is what's reported to credit bureaus. So from the first example, you have a 1,000 credit card balance out of the 2,000 limit during that billing cycle. That is a 50% utilization rate. But if you go into your account and pay off majority of the amount before the statement closing date, you could easily lower that balance to 100 and have a solid 5% utilization rate. And don't forget, the utilization rate is a combination of all of your cards. This isn't something you have to be exact with, but just understand that a high utilization rate is going to negatively impact your score. Now, you're probably wondering, why not just pay it all off? Doesn't it seem like 0% would be the best, and it's at least better than a high utilization rate? But it's actually not as good as a utilization rate in the single digits. And that is because it shows lenders and credit card issuers that you aren't even making purchases with your credit card. So now that you understand that, just make sure that you set up auto pay so that you're not missing any payments that are due by the payment due date, because that has the largest weight to your score at 35%. For those that don't know, the payment due date is about a month after the statement closing date, where you will then have to pay off any statement balances like the $100 from the previous example. And just so you know, most late payments are not going to get reported to credit bureaus until at least 30 days after the payment due date. But the impact only gets worse the longer you take to pay it. In fact, a study found that 43% of Americans have missed at least one credit card payment in the last 5 years. So I highly recommend to just set up autopay, pay it full and on time, and you'll have way less worries. Besides that, something I've found to be way easier for tracking purposes is to just change all the due dates for each card to be the same. And by the way, I've created an entire guide to credit cards for free that I think you could benefit from, which I'll have linked in the description below. Moving on from there, something you must always do is review your credit reports. According to Consumer Report Investigation, in 2021, 1/3 of Americans found errors on their credit reports, where another study found up to 42 million credit reports having errors. The credit cards in the US come from 3 main credit bureaus, which consist of Equifax, Experian, and TransUnion, who all vary slightly on their reports. An easy way to view your own credit report that you can do today is through a secure government website called annualcreditreport.com. And the reason to look through these credit reports is so you can search through all of your information to make sure everything is correct and up to date. Some of the main things that you want to check on to make sure there are no mistakes is for your personal information, late payments, inaccurate balances showing, incorrect credit limits, any mysterious credit pulls you're unaware of, or maybe an account that was closed that you still have open. Whether it be identity theft or the credit card company is inputting the wrong information, if there are any mistakes at all, you can file a dispute to potentially resolve the issue. To do this, you would need to file a dispute with each credit bureau that has the mistake. You need to explain what you think is wrong and provide any copies of written documents for proof. The most convenient way I find to do this is online, which I'll leave a link in the description below that directs you to each of the credit bureaus, which the link below also shows a typical form you can fill out, but there are many different ways you could do this. And to differentiate yourself even more, you could simply ask ChatGPT for a specific form based on what you're reaching out for, or just write it out yourself. Besides that, if the credit card company was the one that inputted the wrong information, I would call in and reach out to them to figure out why they were wrong in the first place. So besides errors in your credit report, let's just say that you had a late payment due to a serious reason, such as a job loss, a divorce, or medical emergency, which, by the way, late payments stay in your credit reports for 7 years, but certain credit card issuers will accept what's called a goodwill letter, which is basically you giving them an honest explanation for the late payment and why it was a one-time occurrence that won't happen again. By doing this, you could then kindly ask for a removal of the negative mark that was put on your credit report, which would help your score, but realize that none of them are obligated to do so, and some companies may not even consider it no matter the circumstances. Or in a different scenario, let's just say that you have an ongoing late payment that you haven't paid off. You can actually negotiate with your credit card issuer because they may be able to help you with the issue, because in the end, the credit card company wants to at least get some of its money back rather than nothing. The easiest way I'd recommend to handle this is to call into the credit card company and mention something about financial hardship and creating a debt repayment plan. You may be shocked, but this could actually put you in the right direction to create a new plan that you could actually afford, and hey, it literally costs nothing but time to call in. Moving on from there, let's now cover the impact when it comes to applying for new credit. Applying for additional credit cards or other forms of debt can influence your credit score, and that's primarily based on timing and frequency. Each time you apply for a new credit, whether it's a credit card or a loan, the lender conducts a hard inquiry into your credit report. Each inquiry can cause a slight dip in your score, but if you do this several times within a very short period, you could actually experience a significant decrease in your score. Another reason to especially avoid this is if you are planning to get a major loan in the near future, such as a mortgage, because if your score drops significantly right before, it can have an effect on your approval and the rates you'll have to pay from that loan. Which, if you don't understand why you'd have a decrease in your score, it's because lenders view frequent application activity as a sign that you are a higher credit risk. On top of that, be aware that new credit lowers the average age of your credit accounts, which can negatively impact your score in the short term. But on the other end, being approved for a new credit card will increase your total available credit, which could lower your utilization rate and positively impact your credit score. With that said, the last topic you need to know about is related to closing your accounts. Closing a credit card account can increase your utilization rate because the total limit for that card is removed and will reduce your overall limits. For example, the table on the top shows 3 credit cards. Credit card A has a 1,000 credit limit and is one you do not use, which is why you're considering to close the card. Based on the data, keeping the card would provide you a 30% utilization rate, where closing it would result in a higher rate at 42%, which, as I mentioned, a higher utilization rate can negatively impact your score. Besides that, specifically closing your older accounts can lower your credit score because the length of credit would be reduced, and that is a 15% weight toward your score. For this, let's say you have 3 credit cards and one card is 10 years old, then another at 3 and 2 years. Your average credit card age would be 5 years, where if you took out the 10-year-old card, the average would now be 2.5 years. So I will say, if you are planning to apply for a major loan soon, like a mortgage, to avoid closing any accounts, especially the older ones, which in that short period of time, I would definitely recommend to avoid anything that temporarily drops your score. Now, if the reason for closing an account is because of an annual fee, I highly recommend to first off call the company and see if you can downgrade the card. And if you have any of those no-fee annual credit cards that you just want to get rid of, I highly recommend to avoid closing them. And to keep any unused credit cards in good standing, just use them once a year on something like a drink at a gas station and you'll be fine. So outside of closing your account, just understand that you don't need to pay for any credit card repair services, because if you follow all the free steps I've mentioned in this video, your score will go up in time, which will allow you to get better rates on loans and higher quality credit cards like the Sapphire Reserve. Plus, if you follow along and take action with the steps I'm mentioning in this video, the only cost to you is maybe an hour or two of your time and the energy to hit the like button below. But truthfully, the knowledge that you can get from this type of video can actually save you thousands to even tens of thousands of dollars in the future if you do things right. And because of that, if you want to learn more about my favorite credit cards, check out my page. I'll have linked in the description below. And while you're at it, don't forget to check out my free credit card guide for beginners, other relevant videos I've made, my Twitter account, and as always, don't forget to hit the like, subscribe, and notifications button for future content like this.